Welcome to the Idea of the Week on Alpha Now. I'm John Cozy. In this session, we're going to show you a technical pattern in US Treasuries that bond bears hope won't play out. It goes against just about everything you've been hearing about US yields. So let's get started. Earlier this year, we observed a chart like this one, the monthly price of the active US Treasury 10-year futures contract. Take a look at the move up that began in early August, when the president of the European Commission expressed concern that the European sovereign debt crisis was spreading beyond the periphery of the Eurozone. Those comments sent European and US markets down between 3 and 4% in one session. It also sent Treasury prices soaring, and that jump created the base of a move of about 6.5 points, from slightly below 126 to slightly above 132. Since then, prices have been moving sideways in a continuation pattern. It's called that because once the sideways movement ends, one would expect to continue the prior trend. And the prior trend is up for bond prices, but down for interest rates. If we do break above the trading range, we'd expect prices to move about the same distance as the initial move in August. In this case, the futures contract may be projected to rise to just under the 139 handle. Now let's analyze yield on the 10-year Treasury using Thomson Reuters Eikon charting. Rates dropped from 2.86% at the start of the bond rally in August, down to 1.8% in September for about a 1% decline. And you can see they've been bouncing along that low level in the congestion zone. Should rates break below that level, technical types will take that earlier 1% move and subtract it from the bottom rate of 1.8% to get a so-called measured move down to around less than 1%. What might propel Treasury rates lower? Well, certainly a flight to quality in US Treasuries coming from money outside the US. It's still the port of choice when the storm winds blow, and much larger and more liquid than the German sovereign market. Possible drivers include continued nervousness about France and Greece rejecting austerity and even other Eurozone members such as the Netherlands leaving. Also, geopolitical issues such as Iran's nuclear program or any further crisis in the Middle East. More Federal Reserve quantitative easing, U.S. uncertainty over what tax rates businesses and individuals will be paying next year, and a deteriorating economic outlook in the U.S. or globally. And if you're looking for evidence of this happening, well, here in the second week of May, the active futures contract on the 10-year Treasury's already broken above its congestion level. And look for active cash buying of the 10-year as it breaks to new lower levels, same as in August. That is a textbook type of confirmation. When could the rally end? Perhaps when the last week short is squeezed to cover. For Thomson Reuters Alpha Now, I'm John Cozy.